Mine supply is roughly 820 million ounces a year, about 25,000 tons. Of that, almost 70%, somewhere between 65 and 70%, comes not from silver mines, but from other mining activities, copper, zinc, lead, tin, whatever. I mean, this year so far, just under 15,000 tons of silver. Roughly 60% of global annual mine supply has been stood for delivery on COMEX alone. But I mean, silver could triple or quadruple from here quite easily in these conditions, unless someone like China relents. And I don't see China relenting, because the higher the price goes, the more important it is for China to hang on to its silver, because it's not, it's not going to be able to replace it. If the price of copper is going to normalize itself in gold, then that is going to go up in gold 4 or 5 times. How much will it go up measured in declining dollars? I mean, 5 becomes your minimum. Don't be surprised to see it over 10 times. Don't be surprised to see it over 20 times. I mean, we're looking at about 2 trillion deficit, plus roughly a third of all, it's not quite a third, but almost a third of all government debt in public issue is being refinanced this year as well. So you've got not just the extra debt, but you've also got the refinancing of the existing debt. And when prices start going down, the banks will start liquidating positions, which will make it go down and down and down. And foreigners own something like 20 trillion of this stuff. They're going to get out, that's for sure. I mean, 20 trillion in the US stock market, in an economy whose GDP is roughly 30 trillion. The new generation of Samsung car batteries, which don't use lithium but use silver carbon anode batteries, they consume something like a kilogram. Now, these are the new batteries, and they give you more range and they charge quicker. I mean, so this is going to go into luxury cars by the end of 2026. So you can see that any manufacturer in the electronics industry, in the environmental industry, in the motor industry, has got to go up there and grab as much silver as they can, because there isn't very much around. Now, in the past, China has actually controlled the market, because not only is it the second largest nation by mine output, but also it's been importing doré and other base metal ores for refining, and so is the largest refiner of silver in the world by long. So it's controlled the market, and it's managed to suppress the price for a long time. Then President Trump came into the scene, and he started monkeying around with tariffs on China, threatening them this, threatening them that, 150% tariffs, and so on and so forth. So what did China do? Turned around and said, well, if that's your game, we'll stop supplying you with the things you need. And they started with the rare earths. From next month, officially this is the case, and I think it's probably already de facto the case, China is restricting the licensing of exports, silver exports, out of China. And the reason for this is quite simple. It recognizes that it can no longer control the price.
Economist Alasdair Macleod delivers a scathing critique of official economic data, arguing the headline 4.3% GDP number is a dangerous illusion inflated by government deficit spending and credit deployment. The true state of the U.S. economy, he asserts, is revealed by the Federal Reserve's own Beige Book, which indicates America is entering a recession. He warns the perfect storm is brewing in the bond market, where a massive $2 trillion deficit, the refinancing of a third of the national debt, a declining dollar, and rising Japanese yields will collide.
And the Beige Book says that we are going into recession, or sorry, America is going into recession. It's clear to me, I mean, from everything I hear about business conditions around the country, that is the case. Equities are in a credit bubble. And the other side of that credit bubble is obviously debt. We can see we can even imagine without stretching our bond yields rising in Japan, which means that Japanese institutions are less incentivized to buy US Treasury debt in preference to their own. This actually is, it's a perfect storm brewing in the bond market. What gold is reflecting is it is reflecting a lower purchasing power of the dollar, not just now, but anticipated in 2026. Gold is discounting, I think, what's likely to happen, what the smart money sees happening to the dollar in 2026. In other words, the purchasing power of the dollar goes down, and the nasty surprise for everybody will be inflation goes up these metals. I mean, silver I regard as operating as a base metal, if you like, with some sort of psychology about, being a form of money on top. The underlying situation is that if you look at the value of base metals, valued in gold, not in fiat currencies, because the value of everything in gold basically is pretty constant over long periods of time, fluctuates a bit, but not nearly as much as it does in fiat currencies. What's happened is that, a sensible basket of these base metals is worth roughly 18% of what it was in the year 1900. In 2008, since then, I mean, it's because I was calculating it for copper, the value of copper since 2008 measured in gold is 8% of what it was then. Credit bubble, because the other side of the debt bubble is credit. For every debt, there is a credit. And a lot of that credit has been angled at the stock market. Once the debt bubble runs into trouble, the credit bubble will run into trouble. You will get a collapse in equities because it's a bubble. It is a bubble. And when you get a bubble, I mean, the denouement is extremely unpleasant.
Forcing bond yields higher and bursting the equity credit bubble. Gold, a severe decline in the dollar's purchasing power and rising inflation in 2026, driven by tariffs and a broader commodity squeeze. Silver faces an even more acute crisis, with China halting exports and industrial demand from solar and new EV batteries using 1 kilogram each, colliding with a fixed supply, setting the stage for a historic physical short squeeze that could see prices triple or quadruple.
Of GDP equivalent in the stock market is held by foreign interests. Are they going to hang around when it starts going down? No. Add that to the list of speculative positions, and I think the collapse in the stock market will provoke the Fed into massive QE. They will have to protect the economy as much as possible, because that, I'm afraid, is their mandate. It shouldn't be, but that's where we've gone. And instead of having stepping back and protecting the value of the dollar, they'll sacrifice the dollar on the altar of intervention. The mainstream media, mainstream institutional investors aren't talking much about inflation in 2026. I mean, they see the economy stagnating, and if you're a Keynesian sort of thing, in other words, ignorant of economics, I'm sorry to say, then you would think that stagnating economy basically means less demand for goods, and therefore the prices of goods are unlikely to rise. Best case sort of thing. Could even fall, which would justify further Fed intervention. It also includes pretty much all government deficit spending. So if you take that out, then you can understand that there is a huge difference between what GDP might tell you and what other anecdotal evidence, such as unemployment and what's actually going on around the country, tells you. So, I mean, my view on the economy is to ignore GDP numbers, but actually go on things like the Beige Book, for example, which is the Fed's own survey around its districts, with contributions from each of the Federal Reserve banks in those districts, which are, I think, 11 districts or 12 districts or something. You've always got buyers and sellers. There's always depth, if you like. So if the value of something like Nvidia or Microsoft increases, there will come a point where people take profits and they will sell into the market. So you've got that sort of liquidity. So what happens basically is that as prices rise, then the sellers come in. So demand, if you like, balances supply at a higher level. Now we all understand that because we've all seen the graphs that that have been shown you in high school. Um, but this is very, very different. We have a situation where that's reversed because the higher the price goes, the fewer sellers there are. You do not have investors in this market. You only have industrialists. Yeah, I mean, okay, you might have um, some ETFs, but that's a relatively minor thing. The big players in this, for example, are China. They've been very, very big. They've just withdrawn from the market, which is why this crisis, if you like, in the derivatives market has come about. Now, following that, the inflationary implications of that, in other words, the implications on the purchasing power of fiat currencies, uh, was obviously negative. And for that reason, gold rose. I mean, having fallen from $1,000 before all this happened in 2000 and early 2008, 2007, fell down to about $670 and then rallied subsequently to 920. That was a peak, I think, in September 2011. Now, that move basically reflected the effect on the purchasing power of the dollar from the Fed's open-ended check, if you like, the rescue. And not only that, but the ongoing problems that we had in Europe in particular. You had the Cyprus banking crisis collapsing. You had Greek banking crisis collapsing. We had everybody started talking about the pigs, Portugal, Italy, Greece, and Spain, and so on. So there was a lot of uncertainty around. There was big, big credit risk, if you like, in these markets, but not in the US, in the US government bond market. The level of debt was considerably lower than it is today. The other factor I would say is that in those days, China was less of a player in the international scene than it is today. The sort of concept, virtually very few people had heard of the Shanghai Cooperation Organization. And the only reason we heard of BRICS was because an ex-Goldman Sachs economist, who's British, came up with the acronym for these emerging economies. At that stage, they weren't emerging economies as part of the Chinese stroke Russian sphere of influence. They were just emerging, BRICS. It was Brazil, India, China, South Africa. So you had, that's what it was. It's good, it's a good classic commodity squeeze. And we're seeing the same thing, basically. I would argue to a lesser extent in platinum and palladium, particularly platinum. Which, I mean, in that case, I think the platinum price has been suppressed for a very, very long time. You've got very few manufacturers, mining entities which produce any reasonable quantities of platinum and palladium. Open vaults in Hong Kong and also Saudi Arabia, where gold could flow in and flow out exclusively against Chinese yuan. The one thing they haven't done is fixed a rate yet. I think they will fix a rate to protect the yuan from when the dollar really starts sliding. So that's something that we could see by the end of 2026. And I think those, if you like, it's those factors which make the difference. The idea that the authorities can come in and bang the market, knock the gold price down from, I mean, at that time it went down in 2011. The high was 1924, I think, intraday, and it went all the way down to something like 1,040 by 2014-15. The idea that the American authorities in particular can mount an attack on the gold price and drive it down from the current level of 4,400-ish, so that it doesn't become a problem for them ever again.